Thanks everybody for joining. Today I'm going to talk about two main subjects. Funding for franchises, which also applies to, small businesses in reality. It's not just about franchises. I do represent a few non-franchise businesses as well, and this applies to other things you might want to do. Then I'm going to dig into the franchise disclosure document and some of the information that would be made available to you if you're evaluating a franchise. If you have any questions, feel free to type them into chat along the way, just so we don't lose track of them. And I'll definitely kind of pause between the two major sections at the end, and we can have a discussion and, leave things open for people. All right. So first thing we're going to go over is franchise funding, franchise disclosure doc. We will talk about kind of expectations around franchising and the financial performance. It's very important to be realistic when you're going into something like this. It's very important to me that people I work with have realistic expectations and really dig into, what's going to happen over time, right? Things ramp up over time. We'll talk about working with professionals. That's, very important. So my role is much like a real estate broker, central point of contact, central point of information, find the right things for people I work with. But that's no substitute for, your true financial professionals as we move further into the evaluation, should you look at a business or a franchise. So we'll talk about that. And then, of course, as I mentioned, we'll have a Q&A at the end. All right. So jump into franchise funding. There are a lot of ways we can fund a franchise, some that you've probably occurred to you already. Some are somewhat obvious and some are not. And I'm going to, touch on each one a little bit. So we're going to talk about these 5 options. 3 pretty common you may have heard of, 2 probably less common, and then there's often more than that. It's very common for people to use a mix of options, right? When you're dealing with any kind of loan or financing of a significant amount, you're going to have a cash investment, some skin in the game, right? Personal savings, cash on hands come into play. You can also combine multiple loan types depending on your particular situation. So we'll dig into that as we go through. I'm going to talk about each one of these, kind of pros and cons. So personal savings, cash you have on hand, right? Again, you're going to need some portion of this no matter what direction you go, but not going to pay interest, not going to affect cash flow of your business via an obligation to pay back, right? You're going to pay yourself back. Of course, the con, you're risking that money. So in this case, we're thinking about, maybe I have $100,000 in my hand, but I need a $200,000 investment. Do you put the whole $100,000 in, or do you use a minimum amount of cash to launch and facilitate other funding, right? Part of the analysis that gets done as you walk through a franchise that we'll talk about, and again, financial professionals as well. So SBA loans, right? This is a big subject. SBA loans are huge in financing. The SBA is very familiar with franchising, especially with your bigger brands. They've already given that loan out 100 times, right? So they know how successful the owners are. Now, the SBA is the government organization that essentially backs the loans, not unlike your Fannie Mae, Freddie Mac. Your individual banks are the ones who are going to grant you the loan. So you're still going to go through a process of qualifying, providing cash, as we talked about, your skin in the game that everyone likes to see. There are loan programs that are quicker than others. You'll hear things, and different financial institutions call them different things, but you'll hear about quick start programs, faster programs. If you're looking for under 150K, as things stand today, you can usually get into the quick programs, and there's an opportunity to close a lot quicker. When you are talking about loans under 500 or 600K, you're likely to be able to do something that you do not have to, you know, for example, have a second mortgage on your home, or, you know, put your home up as collateral, for example, right? This is big for everybody. For SBA, you're going to want a credit score of 685 or higher. And depending again on the loan, you know, 18% cash injection is a good target to think of. Different franchisors will have relationships with lenders, and they may have lower amounts than that 18%. You know, I've heard as low as 10, right? So a lot of flexibility here. Cons around SBAs, you know, the rates are variable, right? It's like a continuously variable loan. It's prime plus. It's not necessarily a fixed like prime plus 2%, right? There can be some variability there, but it does go up and down with prime. So it goes up and goes down. So as you can imagine, you know, right now, and especially 6-12 months ago, the rates are pretty high, right? The process to apply, yeah, it does take effort. It's like applying for a mortgage. You know, you're going to be doing everything you do with a mortgage, and on top of that, you're going to be dealing with business plans, cash projections, things along those lines, you know, which we'll touch on as we continue to work through this process. So, but very, very popular amongst franchises, SBO loans. Home equity line of credit, right? Again, you'll see this used a lot in combinations with other things. But if you do have a lot of equity in your home, you know, leveraging that will get you a lower interest rate tied to mortgage rates. Mortgage rates are lower than SBA loan rates typically, right? Today they are. So the con is, or the pro is lower interest rate. Cons, of course, you're securing it with your real estate, right? But often forms part of the overall loan program you might want to get involved in. So portfolio loans, this falls into the category of something people may not have encountered before, but you know, if you have, you know, significant investment portfolio, that, you know, that is an asset you can use to secure a loan. When you have security against a loan, a physical asset, the rates go down, right? If you're opening a franchise, and there aren't a lot, but if you're opening a franchise that a component of it is owning a physical piece of property, for example, versus leasing, you know, that can lower your interest as well. We have a few options like that are, you know, popular with real estate investors. So, you know, can be interesting if you've been in the corporate world for a long time. Like a lot of people I work with, they've kind of built up a portfolio, right? Similar to a loan we'll talk about in a little bit. And again, secured with your securities. So you have an asset that is, you know, at risk. So this is another one that not a lot of people have heard about: rollover for business startup. ROBS, as it's commonly known, is actually an IRS program, right? Funding company kind of came up with this quite a while ago. Multiple financial institutions offer setting up this program. Essentially, if you have rollable funds in a retirement account, and you know, there are 10 plus different types of retirement accounts that this applies to. It's not just a 401k. It could be a SEP if you've been self-employed. There are a number of funds that are only available to, you know, government and military personnel that applies to, that you can utilize. One of the keys to understand if you can utilize is if you could roll it into another institution or type of an account right now, right? That's kind of the first criteria to think about as you look at this. What you're doing with a ROBS backed loan is you are going to form your own self-managed retirement account. So that's kind of entity one that you're in charge of. And then you're going to form a C corporation that is going to represent the business you're starting, the franchise you're buying, right? So your C corporation is going to issue stock that your managed IRA account is going to purchase. So you issue 100 shares of stock, they're $1,000 per share. That's how you fund your business. Now, if any of you are into real estate investing or alternative investments, you might also be thinking about self-directed IRAs. There are similarities between the two. With a self-directed IRA, people who invest in real estate and commodities often use that, and you cannot benefit directly from a self-directed IRA. So you can't buy a multifamily and live in one of the units. It's a big no-no. You can't even renovate a home yourself you buy with a self-directed IRA. With ROBS, it is very interesting because you can pay yourself a salary, right? So you're going to set up the C corporation and you're going to be an employee of the C corporation, probably the president, right? If the funding from the ROBS ultimately pays a salary, that's acceptable. Now, ROBS is still highly scrutinized by the IRA because, you know, you're utilizing your retirement account without tax, without penalty, right? For kind of something else. So, you know, what are you not going to do with ROBS? You know, you're not going to buy a boat, put the company name on it and say, oh, it's advertising for the business, right? Unless you're in the marine business. Because in that case, you may just trigger an event where they say, well, you've gone outside the guidelines. So, you know, now your account is cashed out. You get the taxes, you get the penalties, et cetera, right? There's no loan, there's no interest, right? There's no debt service with this. That stock that you've sold to the company, right, is going to increase in value. You're going to run a C corporation, right? Every year that stock is going to get revalued. It was $1,000 per share, $100 per share. What is it worth in year 2, 3, 4, 5, right? Exit strategy from ROBS, right? If you choose to exit and go to a simpler structure as stock buyback, for example, right? And again, you're a financial professional. The companies that do this will give you much, much more detail, but you know, it's year 3, your business is going well, it's very profitable. You want to exit from the ROBS structure, buy the stock back, right? It was $100 a share, now it's $200 a share. You do a buyback, that $200 goes into your self-managed retirement account, should be tax advantaged. If that was pre-tax money, it's still pre-tax money, right? It's a separate entity, you'll deal with that down the road. So pros, you know, no interest, doesn't, you know, not debt service to be dealt with. Potential tax benefits, right? Just like that retirement account. That's a whole separate subject that you're dealing with. Cons, right? It's your retirement savings. If it all goes wrong, your retirement savings is gone. Like any investment, there's risk. Complexity, I've described a lot of it because, you know, you're setting up a retirement account, you're setting up a C corporation, a much more complicated structure. If your corporation has employees, there's some aspects where they could be allowed to actually participate in that retirement account and purchase stock and what have you. There's a lot of rules around that. So what you're going to do, what the vast majority of us would do who are not financial professionals, is you're going to have a company manage all this for you. You know, so it's more costly to set up. And on a yearly basis, you're filing a tax return for the company, you're filing a tax return for yourself, you're filing a tax return for the plan, right? So a few $1,000s a year to maintain, probably under 3, right? To set up $5,000 or $6,000, right? So more complex structure, but very interesting. So I'll move on that from now, and we can discuss further if you have questions. Okay, so how to choose the right funding option, right? It's a mix, but you're going to talk about, you know, what's your credit score? What are you eligible for? Cash on hand, risk tolerance, very important. With some of these, you know, you are putting up an asset you've maybe worked your whole life for. Your retirement account, your home, you know, is at risk. Long-term business goals. Again, when do you want to exit from a strategy like ROBS? How much cash flow are you looking for? You know, are you going to reinvest? Things along these lines. And again, often a mix. So I think that's pretty straightforward. So I'm going to pause here for a moment. because we're going to move on to the franchise disclosure document and talk about the things that you'll be made available to you around finances and funding of a franchise. Any questions about anything we've gone over, or anything people would like to?
No,
Did you have something, Dave?
no, nothing,
Okay, cool.
not yet.
All right, cool. So the franchise disclosure document. So everyone talks about, with the franchise, how do I know if it's going to be financially successful, right? What information will I be given? What does it cost, right? In the process of evaluating a franchise, there's kind of a few steps. We start by talking and getting to know you. I find options for you. We find a brand that you really like enough to invest more time to look at. And not too long into the process, it's different with each brand, they're going to deliver to you the franchise disclosure document. So this is a document that the format is dictated by the FTC, right? So it's regulated to an extent. Some states add regulation on top of what the FTC does around the format. Generally, it is not audited, right? Although there is a section that is likely audited, which I'll touch on in a few minutes. And there's a ton of information in here. It's not just about finances, but I'm going to hit some of the, kind of major areas that are about the finances of the franchise. There's, in addition to what I'm talking about, there's things like what celebrities endorse the product, who are the other owners, things along these lines. So, but we'll jump into here. So I'm jumping right, there's like 21 items. I'm jumping right to item 6. So we're getting into the heart of the money. Item 6, other fees, right? And the order may seem a little off, but I'm going in the numerical order versus, kind of changing it. So item 6, other fees. So this is going to talk about fees you have to pay as an owner, right? Some examples of things you'll see in there: royalty fees, right? The majority of franchises, although not all, have a percentage of gross revenue based royalty fee. And I always tell people, if you know nothing about a franchise, if you're just thinking about a franchise in general, think about 7%. That's a good number to say, like it's probably 7%. It'll be plus or minus, there'll be a lot of other factors. Marketing, and those are like fixed. That's cast in stone. They get the first 7% of every dollar you make, right? You might as well think about it that way. A few have other programs, but it's a good rule of thumb. Marketing and advertising fees. This you'll see probably 0 to 3% is something to think about. And while this percentage they're going to take, absolutely, this could change, right? This is more like a range. We may, and sometimes you'll see 0 to 3%, right? This covers, depending on the type of brand, national advertising, local advertising, the different expenses the franchisor has to make that happen. Although in some cases, it might even go back and you are influencing how it's spent locally, right? But if you think about your brands, your Dunkin' Donuts commercials, all that cool stuff, right? Where's it coming from? The franchise fee everybody pays. Technology fees, right? Some wrap technology into the royalty fees. More and more, you're seeing them split out separately, where, the CRM that they provide that you must use, the management of your local marketing, your social media and what have you, that, every owner gets and must use, can be broken down in technology fees, right? Training fees, right? Sometimes rolled in, sometimes broken out separately. What does it cost to train? It's not uncommon that, as a new owner, your training is at no cost, but you may want to bring along a key employee or a general manager, or in the future, you may want to send somebody to training, and fees would be outlined there, right? These are very general fees. Depending again on the brand, you could see a lot of other things here. So if they're have a proprietary service you must use, you might see a fee associated with that. But again, I'm speaking very generically today. So item 7, estimated initial investment. So when I show you a franchise, I'm going to talk about a couple things from a financial perspective. Cash required and total investment range, right? These are derived from like everything else in here, these are derived from what existing franchisees have paid. And you'll see very specific numbers in there, you know, $100,258, because they've calculated an average, right? They're not making it up. So what are typical initial investment fees? You're gonna have the franchise fee. That's always a big one. Not much of a secret. I get paid out of that one, so that's my favorite, right? Inventory you may need to acquire if your business has something that you're selling. Leases and what have you, and real estate you may have to deal with. You know, initial marketing fees, startup expenses. Again, if you have a retail type franchise, you're gonna have to build out a facility. You may have to acquire a particular piece of equipment. You may have to acquire a vehicle, right? Tools, depending on what it is, right? A lot of potential expenses there. And these tend to be very detailed. It's not uncommon to see 20 or 30 line items here, right? Working capital, how much easily accessible cash on hand should you have to run your business, to pay your employees before you start cash flowing, right? For other things that may come up. And, you know, equipment we kind of touched on. This is a good point just to kind of talk about as well. It's important, you know, because there is a lot of leeway for franchisors when they publish numbers, right? All the numbers are going to have a basis, right? And that'll be published in the document as well. Working capital is one I really like to emphasize with people. They may talk about, this is 3 months of working capital, right? Well, through the process of evaluating a franchise, and again, with the advice of other professionals, you know, you're going to look at your particular situation, and you may decide, I need to account for 9 months of working capital or 12 months of working capital. You never want to underestimate this number. Because the worst case scenario with a business is you get 7 months in, you need to invest more for whatever reason, spend more, and you don't have it available to you, right? Nothing worse than that. Things that affect working capital a lot are salaries in some cases. You know, if you are participating full-time in the business and you're going to be the chief cook and bottle washer and the manager and the employee, your working capital is potentially a lot less, especially in a service business, than if you are going to participate part-time and you're going to have a manager on board or a director on board, right? That salary, until cash flow starts, until your customer base builds up, is a huge expense. And it's a very important expense. You don't want to underspend on a key piece of personnel. So really like to emphasize every number that you see as a range and a basis, and it's important to look at. And we're going to touch on that again in a moment. So item 19, this is everybody's favorite number, because item 19 talks about revenue, right? A lot of people go straight to item 19. First thing they look at, then they go look at the rest. What is the average gross revenue for different, different stores that are open? The franchisor, again, can choose what to publish here. So some franchises have no item 19, right? If it's a new concept, they only have 2 corporate locations. They're looking to franchise. They can choose to publish nothing here. They can say, we've chosen to publish no information. I'm only going to show that franchise to people who have a very high risk tolerance, right? There's a potentially high reward for that, and there's high risk, right? A lot of them in that situation will even derive an item 19 from what they know about their corporate store, right? But it hasn't gone to the point of, having actual owners out there. Now, once you get into a franchise that has, say, 15, 20 locations, it's very common, more common than not, to have an item 19. When you get into hundreds, it is. Also very important to look at the basis of the numbers that they're publishing. Are they showing simply, averages across all units? Have they broken it down? One I like to see broken down is by time opened. Are locations less than 1 year? Here's their information. 2 to 3, here's their information. Mature, 3 and above, here's their information, right? Because you're going to use this data to kind of judge and determine for yourself how your business is going to go over time. When you're working on that SBA loan, you're going to be creating a business plan and projections based on this item 19 and how you feel you will perform against others that you have met within the franchise family. There's a point in the process where you get to meet existing owners, right? And you'll be one aspect of that is kind of gauging yourself against them. This person is doing average. Is that person's skills compared to what's required for the franchise like your skills, or do you feel that you're more highly skilled? Or perhaps, there's an area that they excel at that you're like, wow, I actually don't excel at that. I may have to plan on taking extra time to get up to speed, right? Now, some franchises will go as far as to maybe show you EBITDA numbers, right? So you'll get down into, you get down beyond just gross profitability, right? They might talk about cost of goods. I've seen a couple that even talk about, net profit, right? That's a little bit rare. The question everybody asks, how much money will I make, right? Well, I don't know how much money you'll make. You are going to take all these calculations. You're going to use your local knowledge, understand your local costs, decide how you stack up against the existing owners that you get to talk about. And you have to decide what the profit number would be and how you manage your debt service. And if you have debt is a huge part of that. If you're like, hey, I'm going to get an SBA loan for 82% of the cost to start my business, your debt service is way more than the person who just haven't had a pile of cash or they did robs and they don't have to pay anything back until they feel like it, right? No good franchise or franchise broker will tell you how much profit you can make, how much you can pay yourself, right? Because we don't know. It depends on you. We're going to give you all this data to talk about and calculate how you will do. Now, the one person who can talk about profit are existing owners, right? So when you get to talk to existing owners professionally, ask them anything is my advice. It's amazing how open they are. I used to beat around the bush a little bit about it. I'd be like, when were you able to start paying yourself a salary of $200,000 a year? Kind of a roundabout question, but you can just say, when were you profitable? How much money are you able to pay yourself? What does it look like? They're the ones who can give you an idea. And again, you'll be stacking yourself up against those existing owners. So good. So item 21, right? This is an interesting one as well. This is talking about the finances of the franchisor. This is one of the areas that you may see audited financial statements. Some franchisors are public entities, right? So you can go out and see what their stock is trading at. You can see all kinds of information about them. That's rare. Those are usually the really big parent companies like Exponential Fitness, right? But oftentimes they will have independently audited financial companies. PwC audited their financial data. And, you want to make sure that the franchisor is financially healthy enough to meet the obligations that they've committed to you. I'm not talking about it in detail today, but you also want to make sure that the contract you sign includes those obligations, right? So, you see different things in here depending on the franchises. If they're brand new, they're just starting out, it looks very different than a huge public company, right? Some big entities that have 20, 30 brands underneath them, it's a little bit more convoluted because they're showing information for the big parent versus each individual brand under them, and you might have to sort that out, right? But for the most part, everything in between, good data, do they have enough money to take care of you is really what the bottom line is, right? So this is an important one. I think this is sometimes overlooked, but very important. And again, risk reward, what's your risk tolerance, right? You'll decide if you're comfortable with, their levels. One person might be very comfortable with it. So they've opened multiple businesses, they've done small businesses. Another person might be very uncomfortable with the same numbers just because they don't have that experience. It's harder to interpret. you know, like me, they're a little older and saying, hey, I'm thinking about risking my retirement account, so I want something, with a little more basis behind it. So the answer is different for everybody. So kind of touched on this ahead of time, right? Financial stability of the franchisor, right? What is their health? And what's your risk tolerance? So, financial expectations, right? As you go through the process of acquiring a franchise, especially if you're going to do something like an SBA loan, and I keep bringing it up because it's so common, you're going to do projections, right? You're going to have to do a lot of work to even get that loan and show the bank that you've thought this out. And in part of that, what are the current market conditions? What about where you're opening? What is your local knowledge? What is the market law knowledge you have for your location? They're not all the same because no, you're looking at averages across a brand that's probably open everywhere in the country. A big brand with hundreds of locations in every state. You have to adapt the numbers to your own state. This is an important exercise to do, whether you have to do it for the SBA or you're doing it for yourself to make sure you have the right information. So, and then of course, how do you feel about all this? Again, what's right for one person is not right for another. We all know people who just jump, hey, I'm going to go jump off that cliff. I think it's cool. I'm not that guy, and some people are much more cautious. So where do you fit in that from a financial perspective? So again, set realistic goals, right? All of us probably look at that item 19 and you look at the top 20% of performers, and those people are, their revenue is $3, $5, $7 million a year. And you're like, that's me. And it's going to be 50% net profit. And you really have to step back and say, no, the first year, whatever looks most realistic, then subtract 20%, right? Understand that those first few years you're building the business, but a franchise is a program. Most agreements are 10 years. The first few years, it's a slog. And then hopefully that like year through 3 through 7 is the big payoff, right? The big payoff is the cash flow, the lifestyle, how you choose to compensate yourself, or maybe at year 6, you've just built a valuable business and you just sell it, right? Understand ongoing costs. Again, we talked about it. I am going to beat this to death. You don't want to run out of money along the way. Understand the royalties and commitments. Some have minimum commitments, right? It's 7% or $2,000 a month, right? Understand all that and make sure you're comfortable with it. And of course, operational expenses. This can vary hugely depending on type of business and your involvement. Service business you're heavily involved in, you're going to minimize those costs, right? And prepare for an emergency. Hopefully you never get into it, but run through those what if scenarios. So, and I'm not trying to be negative here. I just want to emphasize that, I want everybody I work with to really be prepared and then go out and not need any of this and master the universe. And again, if you're dealing with SBA and what have you, they're going to want to see all this. Even the franchisors, they want to make sure that, you can pay for your groceries for that first year while you're getting the business up and running. So a good franchise is going to care about all that because they're going to make money when you succeed, not any other way. So, this is critical, working with professionals, right? So again, unlike the real estate broker, I can tell you who I think the great contractors are and the banks I love and what have you, but ultimately you're going to go form relationships with them. Financial, and as the further you go into the process, the more people you're going to get involved in the process. So, one thing that's not listed here is a franchise attorney, right? So you're going to look at the FDD, right? It's kind of early in the process, within your first couple of weeks of evaluating, here's the FDD. At some point, you're going to feel comfortable that this is the answer for you. The first person you're likely to talk to if you don't already have, a bunch of professionals that you deal with, is a franchise attorney. Now, a franchise attorney is not like a regular attorney. The difference is, the franchisors will not typically change a contract, right? In the FDD is going to be the franchise agreement and the contract they want you to sign. And if you hand that to a regular business attorney who's not familiar with franchising, they're going to go redline it, right? Because believe me, that document is written to benefit the franchisor. It's leaned towards them, right? And the franchisor is just going to be like, thank you, no. They have agreements, and they have regulations to deal with, that would make it difficult for them to change the core document. Now, what can happen is amendments, right? State to state, you'll see amendments to the franchise agreements to comply with state law. And you as an owner, depending on where the franchise stands, might have amendments. You might say, well, you've committed to do X, Y, Z for me, but I don't see it clearly outlined in the franchise contract. So I want an amendment that states you are providing me with call center services, for example. I might say, hey, we have a call center. It's great. We do cold calling, right? We book appointments for you. Great. It's not in the contract. That means they could stop providing that service. You want it in the contract, so you might add an addendum, right? This is where your franchise attorneys come into play. They specialize in that area. They've looked at thousands of these agreements. They've sued franchisors, they've sued franchisees, right? Very familiar with the whole process. And they'll help you through that. They'll help dig into the numbers, around the franchisor's financial state, item 21, things along those lines, right? So invaluable. I have a couple franchise attorneys I like that I recommend to people. I don't get compensated by franchise attorneys. They just answer my questions. It's like a quid pro quo thing, right? I have questions, they'll answer them. The other nice thing about franchise attorneys, they've done it so much, they often do it as a flat fee basis, right? So you can get an agreement evaluated on a very reasonable fee where, your local attorney, even with franchising experience, because I do have some local people in Massachusetts that are, very capable franchise attorneys. But it's a part of their business, so they do it on an hourly basis. So, you're $180, $250 an hour. We'll see how it takes, as long as it takes, right? A franchise agreement can be 300 pages. That's a normal one. I've seen them 1,500 pages, like a hotel chain, right? So flat fee can be nice there. And then, of course, your accountants, your financial planners, the people you're probably working with today, are going to want to bring on board, to help you with these evaluations. I really can't emphasize enough that don't go it on your own unless you are that financial professional. So, and again, kind of all the different aspects of things, why do you want to bring in these outside professionals? There are a lot of aspects that you're going to deal with as you get closer and closer to ownership. So. All right, good. And a little disclaimer. So what questions does anybody have? I didn't see anything in the chat, but any questions or thoughts on all this?
Yeah, I know this is probably a tough question, but what percentage of franchises are sold within the first 5 years?
So it's interesting. I don't have a percentage off the top of my head, right?
Yeah.
But one of the items in the FDD shows 3 years of history for the franchise, right? And it's an important one to evaluate. So you'll see how many opened, how many closed. And you absolutely drill down, and the franchise attorneys will help you, with kind of what's a red flag in that area too. If you see closers, sales, the question is, okay, why did those people sell? If the franchise has been around for a while, the numbers are different. It's been around for a while, people start to retire, they're just like, hey, I want out. But yeah, you can also see franchises that close because, it wasn't the right fit for the person. It didn't work out the way they thought, etc. So I don't have a percentage off the top of my head, but there's data available. So part of part of what they disclose.
Yeah, I mean, it's kind of like I do real estate investing, and it's kind of like when you buy a house, you don't know if you're going to flip it or rent it. you know,
Yep.
you don't know what you're gonna do. And I guess that's why I was wondering, because I know you build a franchise up and then sell it. That's a talent that people have probably, versus somebody that just wants to get a franchise and then run it for the rest of their career.
Yeah, I mean, it's interesting. There are a lot of, there's a lot of things to think about and a lot of different ways that have gone. I wouldn't say I've run across a lot of people who deliberately do that. In franchising, there are area developer agreements and master agreements, right? So if you
Uh,
decided you're interested in that, you might be more interested in like an area developer or master where you say, oh, for the state of Massachusetts, this newer franchise I feel strongly about, I'm going to buy the whole state and you're then going to sub-franchise it,
uh,
right? It's a different kind of thing. And again, you need some experience and business acumen to get into that. But you also see, there's kind of a big name in franchising. I often talk about his book. It's called Stop Chasing Two Rabbits, right? And people are interested in it, hit me up because I'll send copies to people, right? Um, before he was involved in franchising, his family had a personal situation. It was very interesting. There's a documentary about them. But they decided that, to deal with something in the family, they needed a lot more money. So they opened a Massage Envy franchise and another and another and another. Um, After they had 5 or 6 opened, a group came in, they were number one in the country and bought the whole thing from them for a very significant amount of money. Wasn't really their intention, but it absolutely achieved their goals, right? Then they went and did it with another brand and got into the franchising industry. Now the guy's a VP of development for a franchise, right? So he really embraced franchising. So those investors will come in and look to buy as well. But again, I don't have personal experience with people who have gone in with that as a goal.
got it.
But exit strategy is important, right? Because some franchises rely solely on you and your expertise. And when you leave the business, the value goes out the door. On the other hand, others, you build up a base of customers, sometimes customers with contractual obligations to the franchise. And now you have a nice, valuable business you can pass on, right? So,
Okay,
good,
thanks.
great. Anything else?
No,
Hey Vin, it's Ned. How you
Hey, Ned.
doing? Hey,
Good.
buddy. Hey, what type of training does the franchisor provide? I mean, like when you sign the dotted line, you get things going. Is there some kind of, are they going to hold your hand a little bit, or is it, I guess every franchisee is probably a little bit different, but I know that they're invested in you being successful for sure. So I would think that they would want to help you with sort of how you conceptualize launching your your franchise.
Yeah, for sure. It's interesting to bring that up because it's a bad habit people in my line of work have. We forget to talk about that because to us, it's just like, of course, they train you on everything, right? Which is a very broad statement. But so yeah, once you sign up with the franchise, they're going to have kind of standard training programs. These days, there's a lot of, very structured online programs that you start by going through, and then
Mm-hmm.
in-person training as well, right?
Mm-hmm.
And I'd call that kind of the base. That's all the 101 stuff, right?
Mm-hmm.
Um, they will have everybody establish that base. Also, you're going to start working with typically a franchise business coach that you'll be assigned to. And that's the person that, especially for your first year, you're probably going to meet with them on a weekly basis. You're going to, talk about KPIs. What are they? How did you do? How did you perform? What can we do to, resolve issues? They'll have add-on training for your, if you have employees, you bring that first employee on board or a manager, you can send them to training. We touched on that in other fees because sometimes that's a chargeable event. There are some franchises, sales is a very important part of just about every business, 95%, right? Some franchises have, contracted with very well-known sales professionals or groups that add that sales training. And then there's, of course, the operations of the business, so they literally have a book they give you. This is how you operate your business. When you buy a franchise, when you're awarded a location, the right to those operating procedures is a big part of
Right.
what you're paying for. So there's training on that. And you know, there's a group of professionals at the franchise that you always have access to go back and work on areas that you need to work on or you have an uncomfortable, you know, some uncomfortableness with. And on top of that, with a lot of franchises, you're kind of joining a family where the other owners, there'll be owner networks that help each other out as well. Some do it very formally, some do it less formally. Some actually sign you to an owner mentor, right?
Mm-hmm.
Or use a form of one-on-one relationship with that person.
Yeah.
And part of evaluating a franchise is, you know, you get to meet all the people as you get towards the end of the process, meet the actual individuals that, you know, you're going to rely on to fill all these different roles. And it's kind of an important step towards the end is understanding, you know, yes, I can work with this person. This is somebody I want to spend time with, you know, that I can be very open with. And you're talking about your KPIs and they're telling you why you failed and what you need to do better, right? So you want to listen
Right.
to them because you paid a ton of money for that advice. And if there's not a match, then we move on to something else. Like I really don't like the head of marketing, you know. Okay, that's important to understand. So,
Yeah.
but
It's
yeah,
good to know.
training's extensive. It's one of the huge things that you're paying for. And again, the more mature a brand is, you know, the more you're going to get. If it's a very new brand, it's like, well, you know,
Yeah.
you're spending a lot of time with the guy who founded the original one, right?
Yeah. Yeah.
And you may influence what happens in the brand as you go forward as well, because it's smaller. Some people love that. Some people it's too risky for. So
Yeah.
good,
Yeah. Thank you. That's good. Good perspective.
for sure.
Yeah.
Jeff, anything you're curious about?
No, this is just kind of introductory information for me at this point. Kind of your communications has piqued my interest a little bit. I'm involved in a small business now, and so the interest and the experience level is there. But I'm just kind of absorbing some information. Appreciate it.
Good, yeah, no, and I appreciate you investing the time too, you know, whether it's tomorrow or next year. Hopefully I can, you know, add some value for you. So,
Sure.
good. Okay, so, you know, kind of key takeaways just to wrap things up. You know, understand all the funding options. There are a lot of funding options. I touched on some very common ones. You know, you can also ask your father-in-law for money, right? I mean, there's a lot of options out there. The companies that deal with the financial aspects of franchise, and there are big organizations who that's what they're all about. The good ones, which are the only ones I will refer you to, you know, they take your the entire picture into account, right? And often you build that, you know, portfolio of options. You know, you use the FDD, you're going to get deeper and deeper into it as you go, as you get more serious about a franchise. You're going to pull professionals in that help you with that as well once you get to that point where you're very serious. Financial advisors, you know, people you may have a relationship with already, people you may add, very important. So, and I'm happy to spend one-on-one time. If there's anything that occurs to you that, you know, you'd like to drill down on, you want to understand more about what I do, the other things besides what we covered today, or any aspects of this, you know, don't hesitate to hit me up. The professionals, you know, the financing professionals that I would refer you to, the lawyers, you know, they all have kind of an upfront consultation they do, like people you deal with on a daily basis, where you can get a lot of great information from them as well, right? So if you're kind of serious and you want to really understand your financial situation, I can connect you with somebody and you can kind of have that initial call to outline what's really possible for you based on your situation. So great. I
Love it.
appreciate everybody's time. Hope everyone has a great evening. It's dark here now. A little shock to the system dealing with the fall, but you know, it's all good. So,
Yeah, it is.
all right.
Thank you, Vin.
Thanks,
Thanks,
Jane.
everybody.
Great presentation. Thank you.
Thank
All
you.
right.